Hey everyone, Sean Taggy here, Chief Operating Officer and Partner at Memphis Investment Properties. Today we have a very special guest, a guy I've known for several years. He's been to a couple of our events and spoken at them at our Memphis in May events when we have a bunch of investors in. We have Gary Pinkerton. Gary, how are you doing today, man?
Hey, Sean. It's awesome to see you. Thanks so much for having me on. I look forward to talking with all your investors and just kind of sharing my experience.
Awesome, man. Yeah, Gary. So for those people who don't know a lot about you, can you give us a little bit about your background, what you do, and also your specifically, your work, but then also your real estate investing background?
Absolutely. So I'll go back further, and don't worry, I won't scare you with how bad this sounds, how far we're going back. But I grew up in the Midwest there, not too far from Memphis, about 4 hours north of Memphis in southern Illinois on a dairy farm. This was 70s and early 80s. We high interest rates, wasn't really good on the farms. We lost ours actually when I was like a freshman or sophomore, and ran some small businesses with my dad, and then went off to find a free education to get as far from the Midwest as I could because I felt like the world was imploding back there at the time. Tough times for people trying to run businesses and farms with 15, 18% interest rates. And so I just wanted to get a job. Like I wanted a W-2 job like no one's business. So the Naval Academy offered me pretty good terms. They said, we'll teach you for free. So I went there, and then I ended up getting swept up in a full career in the Navy. So I did 26 years as a Navy submarine officer, commanded USS Tucson submarine out of Pearl Harbor, Hawaii. That was the fourth one that I was on, and spent a few more years in the Washington, D.C. area at the Pentagon on the Joint Chiefs staff and at the Naval Academy, teaching ethics and submariners. So it was a really, really good time to kind of finish up where I started. But about the time I was leaving command of my ship, I had had a really bad experience in the markets. And your investors who remember 2008 and 9, if they were kind of where I was, which was in our 40s or 50s, and not wanting to make any more go backwards mistakes like we made in our 20s and 30s. I remember the dot-com crash, 2000. No big deal. I was young. I didn't have that much anyway.
Right.
Then 2008 and 9 had quite a bit in the markets. And I thought that's what I was supposed to be doing, working hard on my W-2 and saving money away and had some advisor control it for me. It was a watershed moment for me. The other thing that was happening, and so I was getting the money out of the markets. But the other thing that was happening was that I was seeing start to happen what I saw when I was a kid in the 70s and 80s. And that was that we were printing money like crazy. And the threats of inflation were out there. And every time you turn on the television, people were talking about inflation. So maybe we'll get into, kind of why that is. But yeah. I wanted to put my money into real estate. And that was my primary goal. And so I was doing that. And I did it for like 6 or 8 years. Met you all. Great fortuitous event. And I was able to get quite a few properties from MIP. And it's just been tremendous with that and reading management.
Awesome. That's great, man. I hear that story so much. And like me, I'm in my 30s. So I heard about all that stories. And, I was just starting my, getting to college and all of that. And I just figured, I was like, man, I got to find a better way. I of course had some in the stock market, but it's totally in someone's control and just not something I can control. And that's where I found real estate about 5-6 years ago. And yeah, so we're on the same kind of thinking level there. I've seen my dad go through that. My other, friends' dads and all that. And it was a rough time, and it really changed my paradigm and view of, investing and other alternatives out there. So we'll definitely dive into that. So tell us, for our guests, for those listening, we've got a lot of people buying turnkeys or looking to buy a turnkey property. So what does your real estate portfolio look like? How many turnkeys do you own and other types of real estate? What does that look like?
Yeah, so primarily in 2011 when I started buying properties, a great time to buy real estate, right? I didn't know that at the time. I didn't know what a bad time looks like. I would say today is still a great time. I don't think people should get caught up on when they're buying. If you find a cash flowing asset that's being managed by an ethical team, like Reedy Property Management down there, I would just go with, especially in a town like Memphis, that just been incredible. A worker's town, right? And that's who you want in your property. So I was just moving money into real estate. So I got, at the time, you could only get 4 loans. I ended up getting 10 because they opened it up as I was buying. And we got 10 in my wife Susan's name. So we had 20 properties, 30 doors. We've repositioned. We had some properties in St. Louis, for example, that we repositioned out of and just kind of moving them into a different area that I feel like a little safer. But yeah, it was about cash flow. For me, though, frankly, Sean, it has been since day one. Like I'm not really a person who's going to retire. I retired from the military.
Right.
I think I'm ever going to stop working pretty darn hard. I just love doing it. And, I started in a completely separate business in the insurance industry of all things. Left the military actually early to do that, but it's more about if your listeners have heard of infinite banking, right? It's about a more efficient place to store and grow a foundation for the family where you are doing it in a tax-free environment at 3 or 4 times what you can get in a bank, and using it not just to store your emergency money, but also to store down payments for the properties. So I kind of stumbled on this in 2011 when I was already in contract on my first property.
Interesting. Yeah.
I read about, like, from Robert Kiyosaki, right? And then I was also reading this old school stuff like No Money Down Real Estate by Robert Allen, right? And I was just trying to figure out, how can I do this without running out of money? Like, I wanted to get as many properties as possible. And I kept coming up with, well, you're going to run out of down payment money eventually. And I also had this concern after looking into the LLCs and stuff. I was almost one of those guys that I'm sure you meet every day with your investors. And most investors have this question: do I need to get the LLC set up and all this other stuff, all this complexity before I even get a rental property? And I'm just saying, don't waste your money, your down payment money. Like, you're not at risk until you have something to be at risk. And it's really not that big a risk. So I try to tell people, yeah, in due time, put the stuff in an LLC, maybe, if it makes sense for you. But anyway, I was reading about that. And I decided I didn't want like any equity in this property. I didn't want my own money in the property. So all that stuff led me to this infinite banking concept. And it has made a tremendous difference in my family's life, so much so that I quit the Navy early, and I've been doing it. And so that's back to me, like, working my tail off, because I really want to introduce this to as many people as I can. So for me, the real estate, the rental properties, it was an efficient, safe place to put my money. But there's one other big thing, Sean. Can I jump into like why I like the mortgages?
Sure. Yes. Dive into that.
So I think I'm probably somewhat unique in this way. And like, people come around to this approach, but I'm not kidding you when I say that at the very beginning in 2011, my primary goal was to prevent my family from going where I saw what I experienced as a kid. I wanted to be protected from high interest rates, taking away all my family's wealth. And so when we were talking about quantitative easing 1, 2, 3, 4, through like 2013, 14, 15, I was convinced the high interest rates were coming. I'd already seen that movie. I wasn't going back there. So I wanted to get on the same side as the IRS. And so I wanted to lock in long-term fixed rate debt that I could protect myself from inflation. Listen, if you have like today, what is it, 3% interest rate loan on your rental property, and 30 years from now, it stayed at 3%, yet the rest of inflation was at 5, 6, 7, 8%, you're going to get wealthy quickly. And so that's what I was doing. I was locking in the long term. So in a really crazy way, most people get real estate for appreciation or for the cash flow. To me, the cash flow is staying power. For me, it was protecting my family and everything I'd worked for all these years from getting lost with inflation. I wanted that long-term fixed rate debt.
Man, see, that's why I love bringing you on. I love hearing about that. It's such a different perspective than what most of the clients I'm talking to here at MIP, they're looking for cash flow, and it's, that is something that you need. Obviously, you want to pay your mortgage and your expenses. But, I've asked you before in our conversations and heard you, your real number one reason is to hedge against inflation. Really actually you're just betting that inflation is going to go up. And so what you're doing is locking in an interest rate on today's dollar, today's inflation. You're going to keep paying that same, what's called a $1,000 a month mortgage, but for 30 years. So in 30 years from now, that $1,000 is going to be worth, who knows, $300 proportionally.
Yeah. Exactly. So, a really simple way to look at it is, even if the interest rate doesn't go up, let's just say that inflation's 3%. I mean, I don't think too many people would say, Gary, you're way overshooting. Most people are going to say, no, real estate goes up 5 to 6%, right?
Right.
But let's just say it's 3%. And you put $20,000 down and get control of a $100,000 asset. And if that $100,000 asset on average goes up 3%, why would it go up like that? Because the US dollar is going down by that much, right? I mean, it's just simply offsetting inflation. So if you have $20,000 in something and it goes up $3,000 a year, it's going to go up more than that after the first year, actually, right? It's going to go up. It's going to escalate. But let's just say it goes up $3,000 a year and you had 20,000 in it. That's not a 3% return on your your money. It's a 15% return on your money.
5 leverage. Yeah.
Right? 1 to 5 leverage. So exactly. So you have that. And yes, there's, 8 to 10% cash flow in most good years. You add that to it. Right. And then you meet Aaron Chapman, and that crazy guy, right? He's making you do math problems on the phone with him. And you realize, wow, just because some tenant is paying down my mortgage for me, I'm making on average 13% a year for those 30 years just from them paying off my mortgage. So hold on a minute. They paid off the 80,000 at 13% a year. I offset inflation at 15% a year. I got cash flow coming in. So people look at me like I'm crazy when I say, well, I think all my properties are doing about 30% a year, right? They think I'm crazy. But when you add it up, it's there. It's right there in black and white.
I love that, man. And that's just, I think that's something that a lot of people just need to think about is you just need to lock in some debt. And just because I see inflation going on more with all these, let's not get too much into politics, but with all these stimuluses and leveraging and supports and PPP loans, the money's getting put into the economy. And also looking at shadow statistics, other websites, it's going up more than 3 or 4%. Lots of scientists say and agree, mathematicians. So
yeah,
I just think it's the good thing to do. And that's why I love talking to you about this and other people who have that same mindset as me and bringing them onto our YouTube channel, because it's just hard to get other people to get on board with this, my personal friends. So I love hearing that.
Yeah. It's, I have a friend, actually not a friend. He's an economist that I follow. I don't know why I said friend. I think he's a good guy. But he's just he explains things really well. And he talks about inflation and how you handle inflation as being in a boxing ring, and the other boxer is inflation. And so most people think about like people who just store their money in a savings account, or they have it exposed to the market or something, or they're on a fixed income already in retirement trying to make it last, right? They go into the boxing ring with a glass jaw. If inflation comes, it's just going to knock them out. But sometimes people do a little bit of studying and they figure out, gosh, I need to put my stuff in like gold and silver and some hard assets so I can at least hold my value, right? Well, now you're in the boxing ring and you have the right jab. All you're doing is dancing around the thing, hoping he wears himself out and doesn't take you down, right? But at least you're not on the ground like the guy with the glass jaw. So that's awesome. Buy hard assets. Totally makes sense. By the way, these houses, if you paid cash for them, that's another hard asset, right? Right? Where am I going to get 100 grand of gold? Well, don't let anybody know you have it. You could get like totally robbed or killed.
Right.
But if you have $100,000 house, they're not going to, it's not going to be as quick to go do that.
It's
right.
Hard
so
to steal someone's title. Yeah.
Right. Yeah. But how do you win the actual fight? Right. So the ability to then hold them off with the jab and then find the opportunity where their guard's down and throw the left hook at them and take them down is with offsetting inflation with leverage. Right. So if you're kind of holding it at bay with hard assets, but then you say, you know what, I'm going to take that 100,000 this time and I'm going to buy 5 of these houses. So now I'm controlling $500,000 with my $100,000, right? Now I'm starting to leverage it. And if that inflation thing actually comes, it's going to make you wealthy. It's going to take you totally out of the ring and have you sit on a cushy chair and watch from that point forward.
Right. Love it. And then kind of going back a little bit, you own 20 properties right now. What states and where have you bought all of them?
Tennessee, Florida, Texas. I've also owned in Oklahoma and Missouri and sold out of those 2. So I'm really in 3 states now.
Okay. And
the majority of them is right there.
Yeah, that little area. Love it. What made you decide those markets? I know a lot of people always ask me that.
Yeah.
What market to pick? You with 20 properties farther along than most people I talk to. Actually, you're way far along, by the way. That's great. Congrats on all that success. But
thank you.
Yeah, why so? Why picking those markets?
So this is going to sound political, but it's just a really quick way to give you the answer. Like if you go look at the 2020 election or any election and you pick the states that are red, that's where I would invest my properties. And why do I say that is because they're conservative and the governments do the same thing. So the biggest trouble you can get into is to have the guy who rewrites the rules after you have the property in that location, rewrite them against you. So if you're buying properties in a bankrupt place, like I grew up in the state of Illinois, I have some good memories about the state of Illinois, but I never had good memories about Chicago. And I have a lot of friends who have bought properties on the outskirts of Chicago. No, this is not a C-class, like where you're going to get your head blown off with a gun area of South Chicago. This is a nice suburb. The problem is the state's bankrupt and it's very liberal. So you end up with a tenant in the place and they're just raising your taxes nonstop. and you don't have the authority to kick somebody out of your own house. So, people will talk about, well, out migration is checkmate. Yeah, it could be, like Detroit. Like, I'm not buying anything there, but it's because, again, it's a very, very liberal place and a bankrupt place.
Right.
And is the out migration a problem? Is it a problem that next year there's going to be less people to rent your place than there were this year? Yeah, that is a problem, but that can turn around. But if the philosophy is, the whole kind of Robin Hood idea where the landlord is this evil rich guy and we need to take money from him and redistribute it to others, you're in trouble. Mm-hmm. So I know that went political, but really what I was trying to say is conservative places that are landlord friendly, that gives you a really good chance of being successful. So, all of those places are, kind of fit that bill.
Man, I couldn't back you up more on that. It is nice. Like, we can get someone out in 30 to 60 days. We go by the law. We have all of our proof. This doesn't need to be something that needs to be dragged on for months and months like other states. And yeah, that's just what's fair. It's like, it's an agreement, an obligation to pay your rent. If you're not sticking to it, then I can uphold my side of the contract and not have all these loopholes for you to stay in forever. And I totally agree. And that's why I love Memphis, Tennessee. And that's why I picked here as well. Let alone it's appreciated a lot, but also just that landlord friendly. You have one more thing on your side. So
the other thing about Memphis is it's just a worker's town. Like, people get up in the morning and they go to work, right? It's just beautiful. Like, one other city that I like that is Indianapolis. So I do a lot of business with my insurance business up in Indianapolis, and I travel there often. And there's this big sign on right next to the state capitol on a parking garage, and it says Indiana, a state that works. And it's just the mentality. Like, people just get up and they add value to the world, and they get paid for it, and that means they pay their rent. And I'm not saying it's perfect. Have I had 100% rent payment? No, but it's no surprise when the property manager says we need to work this out or we're going to kick you out, right? Your team has done a tremendous job helping us out there. Like I said, it's not been perfect, but it's been a really good place, and I think it will be for decades to come. Love
it. Thanks, Gary. Okay, so now we're diving into real estate, and now I want to dive a little more into what you do, whole life insurance policies. Yeah. And I want to let the guests know I have gotten a whole life insurance policy through you. So that's why I kind of also wanted to bring you on, because it really opened my eyes hearing your talk about this. I found it just, number one, I needed insurance. If I die, I want my wife to have, I got $1 million policy to just, support my wife and kids, looking to get more maybe someday. And then also there's so many other great benefits to whole life insurance. And you can actually leverage against that policy that is non-recourse and all that, and all the tax advantages to it. So it just blew my mind when I started diving more and more into whole life insurance policies. And I myself use it to leverage against the policy to put down payments for my properties. So, yeah, can you just dive in briefly about that and tell people about kind of what you do and how you help out other investors?
Yeah, so I think I'm a little bit guilty of not making this like it's a Swiss Army knife. There are people who talk about this as like it's the Swiss Army knife of finance, right? For me, it's not. It's much more simple than that. It is a thing that if you go back and look at, first of all, there's a few different kinds of life insurance. I'm talking only about whole life insurance, like you mentioned. Did a great job of introducing that, Sean. And it's the one that's been around 200 years in America. Never lost money for anybody. It's got guarantees on it, like your premiums can't go up.
And lots of big families have used it, like the Rockefellers. Walmart uses it. Lots of CEOs have them.
Right. Like that. And so it's got this incredible track record, right? But essentially what you're doing is with permanent insurance or whole life insurance. Back up just a little bit. Term insurance, great product. Love it. I've got some myself, and I probably always will. And we actually kind of mix it together with this whole life to make it really, really perform well. But term insurance is a short-term thing, kind of like car insurance. There's no savings side to it, but the whole kind of like model or contract or approach is if you die in this really short period of time, really unlikely that that's going to happen. We will pay out and we'll be okay as the insurance company. Don't worry about us, right? Because there's a bunch of other people that aren't going to die, and we'll be able to use the premiums from there, right? But it's this like game of chance thing, and that's frankly what most insurance is. Whole life insurance is totally a different approach, because their contract is when you die in the future, which last time I checked, there's a 100% chance, right? then they will pay out. So it's a totally different approach. They say, hey, we need to get busy. We need to collect this money, protect it from loss, grow it on a guaranteed increase so that we know it's going to be ready on time for the beneficiary. And then we're going to add dividends to it, which is like company profits. So these are not publicly traded companies. They're private mutual companies. So there's a lot of that privacy and protection stuff you talked about. But the other key thing is that there's no shareholders. So the profits come back to us, the owners of these whole life policies. So collect, protect, and grow dollars, and one day hand it to the beneficiary when it's time to do so. But there's actually money there as compared to like a term policy. And that opens up this amazing window, like you said, that the Rockefellers and many, many other families that have multi-generational kind of thought process with wealth, they collect their money in this environment because it can grow with no taxes. And like you said, more private and protected. And it's got the life insurance side at the end. Personally, I think the number one asset in all of our lives, if you add any value to this world, is ourselves. And so not protecting that thing, like I diverge from those very popular people who will kind of talking heads that will tell people, hey, you need term insurance while you're young. And then when your kids are out of the home, no insurance is required, just self-insure. We don't do that with our house when we pay it off, right? It doesn't make any sense. And the most important asset is us.
The greatest real estate is in between your two ears.
That's right, right? So it's just crazy. So I think I love the life insurance side of it. But the primary reason I'm helping people do this is protecting money in the foundation of their family's pyramid, right? And once you have the emergency savings, the business reserves, the property reserves stored somewhere where it's going to grow nicely and be protected and kind of private so no one knows how much is there, then we use it as opportunity money. And whatever's left over after that reserve stuff is for whatever you want it for, right? It could be kids' college, it could be retirement, but you and I use it for investment.
Great deal, yeah.
Right? And so now you can access the money and use it in a property, bring home more, increase the size of your foundation, go after bigger things. It's just tremendous.
Awesome. Yeah. So there's a lot into it. We're obviously won't be able to cover it all, but if people want to reach out, learn more about whole life insurance policies, also just chat real estate or anything else with you, where can they learn more about you and find out more about you, Gary?
So I tried to make it as simple as I could. And now my friend Aaron Chapman calls me a narcissist, but we'll go with it anyway. It's Gary@GaryPinkerton.com. And you can send me an email that's my email, obviously. But if you go to my website, GaryPinkerton.com, there's an ebook on there you can grab. I have tons of videos too. I don't know that you can access them all from there, but I'll certainly send you whatever you're interested in. Lots of stuff about how to use it for real estate and just how to think about wealth, how to teach your kids about it, how to grow up for generations. It's my passion in life. So do whatever I can.
So GaryPinkerton.com, Gary@GaryPinkerton.com is his email. Hopefully you get some people checking you out, hearing more about you. So Gary, we have lots of guests. We're going to be sending this out to our email list on our YouTube channel. A few thousand people on those. What advice do you have, just take away in terms of investing? That's what a lot of people want. Investing or life advice do you have for people, just kind of to wrap up here?
Well, so the first, I'll go back to my philosophy on how to be successful as a family. So it starts at this kind of pyramid. And a friend of mine wrote a book called Heads I Win, Tails You Lose. And I can get you a free copy if you just reach out to me. But in there's this pyramid, and it talks about like building a solid foundation. I've already mentioned that a couple of times today. And that foundation provides your ability to sleep well at night and to avoid emergencies, to not get caught up in high credit card, interest rates and stuff. And then it provides that funding for the levels that fall above it, right? So then to me, it's base hits in real estate, directly on real estate for the mortgages and all that stuff I talked about. Like I think that should be everybody's first focus beyond improving their own skills, which means more income and quality of life, right? So work on this, build the foundation, and then focus on those directly owned rental properties. And what I mean by base hits are, don't go for the one that you think is going to appreciate like crazy, or the one that has this amazing pro forma like I did for my first one that's in a complete ghetto, and that's why it looks like it's going to perform so well, because you get it for very little to nothing, but no one will rent it. So get something like you can find in Memphis from a ethical, provider, like MIP, absolutely. And then just focus on a base hit, because the biggest risk is that you kind of proverbially have you shoot for the fence, strike out, and then you take your ball and go home. And you're like, this sucked. I'm not doing this.
You lose out on other,
right? You've lost out on an entire lifetime of incredible wealth because you just wanted to hit a home run on that first shot.
Man, I hear you. I agree with that. That foundation is huge. I talk about that a lot. Reserve fund,
Yeah.
you know,
staying power,
work on your finances, your credit, getting all that lined up. Of course, your education, investing in yourself, growing in your income and all that. And then, yeah, man, one property a year, and you do that for 10 years, you'll be the smartest man there. You're the smartest person is just doing that 10, 20 years and you'll be set for life for sure.
I have so many people who ask, hey, don't you think that real estate's at a top? Shouldn't I wait? I'm like, that's just an excuse that you're giving yourself because you're a little bit uncomfortable at where you are. But getting one property, even if it's at the top of the market right now, we look back and we're like, shoot, I bought my first property in 2008. That sucks, right? But think about if you bought it in 2008 and everybody else got it at a much cheaper deal in 2010 and 11, you've got 10 years worth of experience now. And I bet you next round, you won't, be buying at the top again. Like you understand, but that experience level, you just don't want to wait on it.
Right. Well, thank you so much, Gary. Appreciate you being on and you have a good one. Thanks, guys.
Thank you.